Let's talk about the minutes then. Talk about the markets in 3 minutes, and get to what we've seen over the last few days and the insanity being replaced by sanity in markets. I mean, are we heading back to where we were, Mark? What should we aim for in terms of the yield story from here? We recoup some of the losses of Monday, but do we get back to where we were? Is that the aim?
That's a great question, because it's about 6 days ago since the SVB kind of fiasco really started coming on our radar. What has changed since then? Well, we now know that higher rates are having a negative impact on some sectors of the economy. In particular, the tech sector is going to have been taking a real blow. We now know that they're getting a liquidity squeeze. Part of the reason SVB had a problem is because all these startups were drawing down cash at a much quicker rate than they were in the past. They're going to have even more of a liquidity squeeze now. And of course, banks are going to have a higher cost of capital because unsecured creditors got hit. So I think there's a real long-term negative impact from what happened over the weekend. The bit that I've tried to clarify the last few days is that it's not a systemic crisis, and it's not the threat of a systemic crisis, in particular in light of what the Fed has come on and done in terms of their bailout. And I think that's the other takeaway, is that we're actually much less likely to get a financial system crisis now than we were a week ago. And that's really important to remember. That left-hand tail risk has been massively minimized. So while the growth dynamic is more negative, the real extreme tail risks are slightly lower. What does that mean? I think that overall we're going to go back to the idea of 25 basis points from the Fed next week, which, as you know, I've always insisted was never going away in the first place. But I think the market is starting to coalesce back to that idea, rather than the panic calls for no hike or even a cut, which just seems slightly strange. So I think we're going back to 25 basis points as the base case, and even 50 basis points on the table. And second of all, I think that normality, while it's good for stocks and a bit of risk taking, the reality is the backdrop is getting worse for stocks, and they're going to trade lower over the next 6 months.
Okay, and I know you've been asking on the Markets Live blog, you've been asking your pulse question around the Fed. You say 50 still could be on the table, but the markets come back to the idea of 25. Which Fed strategy terrifies you the most? I know is the question being asked. How would you respond, Mark?
I think it would be the fact if they got bullied by the markets and didn't hike enough and let inflation take off again from a much higher platform. So, you know, I want them to stick on the inflation focus. I should emphasize that while I think 50 basis points is still possible, I am very much in the 25 basis points camp. I just think that 50 basis points is more likely than no hike at all next week.
Okay. And US equity futures, I mean, we've heard about the Fed considering tightening rules around smaller banks. Is that something that should spook markets, or in fact something that should give them confidence, given what we've seen over the last week?
It won't spook markets, but again, it's going to raise that cost of capital. It's going to raise the expense of doing business. It goes back to this idea that, hey, these banks are going to want to lend less freely. It's more expensive for them to do business. I think it's going to get worse for stocks. It's going to get worse for the economy. I'm not sure that stocks are going to be trading higher in a week from now. My guess is probably they'll be lower.
Okay, Mark, thanks for thoughts so far. Remember, you can get up-to-date analysis and insight from Mark and the rest of the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal.